Hey everybody, I'm Rob May. I'm the co-founder and CEO at Neurometric.
Hi, I'm Anna Kirk. I'm the Chief of Staff at Nadia Partners.
And I'm Ryan Epley, co-founder CEO of Root Access.
And this is the second episode of the AI in NYC show.
And AI in NYC is covering anything in AI at the intersection of AI in New York. So we're talking to different builders, investors, anyone doing interesting things in New York City and the impact it has in the city.
Very excited for our guest today. He's been building in New York way before it was cool. We have some really amazing topics teed up for us, some current events on AI, as well as Rob's going to introduce our guest.
So sitting here to my left, our guest today, Stephen Messer. I've known Stephen for about a decade now. And Stephen has the very interesting background of, three things that I'll use to describe you. Number one, got a law degree from NYU, but never practiced law. Number two, built a tech startup in NYC before it was cool, which we'll talk about. And then number three, was a very, very early AI entrepreneur back when most people didn't think it was a viable place to build. So Stephen, welcome to the show.
Thanks for having me. I'm excited to be here.
Yeah, so we should probably get started and talk about how you and I met, because it's kind of relevant to the New York thing. We were invited to a dinner maybe 2015 or 2016 by James Cham from Bloomberg Beta. And it was in San Francisco, and we ended up sitting next to each other talking about why we like the East Coast more than the West Coast.
Yep, that's very true. I think I called San Francisco the Boston of the West Coast for the ugliness of the people and food. And you were living in Boston at the time, and that's how we became friends.
I was, yeah. And then you started reading my newsletter, and we started hanging out when I came to New York.
Very much.
So you've been here a long time. You're a super proponent of New York. You're one of the guys that got me to move here.
Yep.
You and Charlie O'Donnell, who we had on last week, were always on me. Tell us a little bit about what it was like. When did you guys start LinkShares?
We started LinkShare in 96.
Yeah. What was the tech scene here like then?
It was actually great. Remember, most of what started off, you had things like Pathfinder, which was one of the early players in the market. You had AOL, which was in Virginia. So most of really what you had in the tech, other than maybe Netscape early on in some of the search engines, you really had it splintered. You had Lycos in, I think it was Waltham, Massachusetts. You had, so what you had was this very broad and diverse background of people. But because it was media, New York really became a center place for people trying to define what is this new medium going to be. So it was a great place to be here for experimentation. And all ideas were welcome, which was pretty great.
Yeah, and explain to people what you guys did.
So LinkShare provided something called affiliate marketing. Affiliate marketing is today the engine that drives almost the entire economics of the internet, which is essentially, think of it as a commission for some kind of action that you want to take place. It could be a click-through, it could be a lead, it could be a sale, it could be you name it, and you get a commission. And LinkShare provided the entire infrastructure to allow somebody to track accurately all the way through. We invented a non-cookie based way of doing it, so it was trustworthy. And then we were the only network that tried to bring everyone together in one place so you could sell multiple people's things. And that was pretty revolutionary at the time. And the whole thing was.
And what was it like to raise money for a company like that in that time period in New York?
It was fucking hell.
I can imagine.
What year are we talking here?
This is 96.
96.
It was brutal. It was about as brutal as it got. We almost had to move to the West Coast. Tim Draper, who's an amazing venture capitalist, came out, loved what we did, and was like, I want to do this, but none of my partners will do it if you're in New York. And I was a New Yorker by trade. I also felt that we were both media transactions. And when you go out to the West Coast, they have a very hard time with anything that's not like pure and easy to understand. And more importantly, if it's not in the common vernacular of what everyone's doing, they have a really hard time. And we were not at that time. People were saying advertising is the way to do everything, and that's the only way to do things. And we thought, this is insane. We're a very big first principles group of people. And we were like, so you have advertising that wants you to stay on the website, but they have to have enough click-throughs to justify the cost. Like, none of it made any sense to us. And but we were really, it was just, so we said no, and we weren't going to go. And Tim's, to this day, fantastic supporter of us, even though it didn't work out. He came and spoke at one of our events, but that was really it. We ended up having to raise money from Internet Capital Group and Comcast at the time, who were both Philly-based. That tells you a lot about the number one financial capital sector, and I had to go to Philly to raise money from amazing investors, but still I had to go to Philly.
Yeah. But then you guys had a sort of typical startup story, almost died a time or two, almost shut down.
Oh yeah.
Ultimately made it, had a fantastic exit. You and
multiple deaths.
Yeah.
Yeah.
And then you and your sister, who you did the company with, Heidi, sort of became like New York legend entrepreneurs because you were at that time and place, and then when that was all over and done, you decided to do a new company.
Yeah, stupidity doesn't ever leave you, no matter how successful you end up getting and how much luck falls on your side. You do end up starting again and again, and you know this, Rob, as well. You have been pulled back in, despite saying, I will never do this again.
Yeah.
Humans have stupid biases that make them forget. Cognitive dissonance is a bitch, and you end up doing it all again. But yeah, we ended up starting Collectivei all over again. But for the listeners, yeah, Linkshare almost died multiple times. Brutal deaths, and we somehow squeaked by, and then it turned into a cash cow that exists today. We sold it to Rakuten. Rakuten Media is still Linkshare, producing ungodly amounts of cash on the original PHP stuff that we wrote years ago. They haven't changed the line of code, and God bless them for that.
And Stephen, what were the main moments for you where you kind of had a light bulb moment and you realized, okay, I need to course correct. This is a moment where we need to pivot and define that new direction for Linkshares?
We never pivoted. No, we bared knuckled
Double
through
down.
it.
Yeah.
So what happened in our world was there are two things that are challenging. When we first started, we were a network model. Nobody gets network models. So everyone was like, this makes no sense. And we had a competitor at that time, BeFree, which is a horrible name, but another Waltham company. And they would go out there and say, I'm going to build you a software and you pay me $1 million or $2 million and we'll give you affiliate marketing. And we were out there saying, hey, you just pay us 2 to 3% of transactions, and anything that flows through us, you'll get money. And the challenge of affiliate marketing is, if you're selling a network, the first player you sell is like, that's awesome. How many websites do you have? And you're like, well, after you, and that sort of ends the conversation. And then we started getting people to sign up because it was relatively inexpensive. And network effects models tend to have this thing where you give away a lot in the beginning to get people to sign up, and they'll take a chance because it's really low risk. And we started getting better and better at getting that. But remember, 2 to 3 cents on a dollar. That is, you have to have a lot of transactions flowing through you. And we started taking off and growing very quickly in around 2000. And this is boring, stop me. In about 2000, and we started getting really to a nice place where transaction volume is picking up. And I don't know if you remember, but in 2000, there was this little problem of dot-com companies blowing up pretty quickly. But prior to that, we were actually having a hard time selling people because venture capitalists were throwing huge amounts of money at Webvan and eToys, and all these other places. And they wanted to buy the expensive version of affiliate marketing, because our competitor would say things to them like, you're going to own your affiliates, which is, if you think about it, logically is insane. They're a separate website who's essentially being paid by you. And by the way, I'm telling you all the story because when we get to Collectivei, it ties directly in. And we were like, yeah, no, that's crazy. We ended up winning that battle, but in 2000, we lost about 2/3 of our customers in the span of 3 months, with about 180 days worth of payables. It was pretty ugly.
And you mentioned 2 of your biggest investors were Philly-based. Now you can't walk down any street in Soho without bumping into a venture capitalist. What do you think has caused the New York ecosystem to change so much over the last couple decades?
So I'll give you my honest take. I think it was hard to get venture capital in New York because, for the most part, venture capitalists are the C- students of finance. Well, I mean, I don't mean that to be mean. Like, I'm not saying it in a negative way. I'm actually saying it in a factual
They'd
basis.
probably agree with you.
No, I'll say, because look, if you are a venture capitalist and you look at the economic model of VC and you compare that to any other asset class, you'd have to be mathematically challenged to say, this is where I want to spend my time.
Yeah.
Very few VCs end up at the top making a lot of money. Most of the funds are generally poor performers. Unlike a hedge fund, you can't mark to market. every year. So you can't take cash out. You can't long and short like you can in a hedge fund. I'm giving the alternative asset class. Forget like debt, which is like a much bigger asset class, and even equity is much bigger.
Yeah.
So like if you've gotten to the place where you're like, this is where I want to spend my time and make my wealth, you have already failed the basic finance. So I think, and the reason why I said it's hard for New York is because you have amazing opportunities in finance. If you were a junior, like if you just graduated, you could probably have $150 million hedge fund where you can do 10x borrowing easy. And now you're magnifying your returns. So why would you do venture? So I think what's happened now is a lot of people are realizing that between secondaries, and between the lack of innovation around venture, that you can be in New York and start innovating. And if you think about the minor iterations in venture, they have changed the market. You can look at things like First Round Capital, came out of Philly from an entrepreneur, modified the venture world a little bit by promising you at the end of a meeting that you get a 50, 150, or 100K check immediately, and they'd be your lead. And they stole, people were flying from Silicon Valley to Philly, which isn't a great airport. But they would fly there because they were like, that's an example of where I think the East Coast has a real advantage, which is we think about innovation and can you make this market much more efficient? And I think the idea, for example, that a venture capitalist has to stay in with you through the A, B, and the C, and that it signals there's a problem. No, secondaries are normal now. Yeah. And that's why you're starting to see a lot more real investors coming in.
Yeah, it is. You bring up an interesting point, and you think about just the ownership math and fund economics of that. Like, it is an outliers business. And if you are a VC fund that owns 5% of a company, think about the exit that you have to right size that investment.
And IRR, the biggest factor is time. And you're building a model that is not time dependent. If you're a seed and you can get out some secondary in an A and a B, your IRR goes through the roof.
Yeah.
You don't have to have those crazy all returns. And nobody bothers to do the basic math because of this whole idea that I'm adding value by staying in. I frankly don't want a Series A or B investor on a board of a C and D company. That's not their skill set. They shouldn't be there.
Right. Yeah.
But yet they somehow think that's a value add. I don't get it, but good for them. They are C- students. Should I pause? I mean, you tell me. I'll keep going.
No. I mean, I agree with you, right? It's part of, we were talking about this at coffee before the show, that I've stopped doing a lot of early stage investing for that reason.
Yeah.
I mean, I think it's fine to be a small percentage of your portfolio or whatever, but you can't use leverage. You can't, there's just all these things that you can't do. And it makes it harder. And particularly when I started doing it 10 or 11 years ago, your average holding period for an early stage company might still be 7, 8, 9 years. And now realistically it's 12 to 15.
Yeah. And so we at Nadia, we're building, we're incubating. So I'm not taking any offense to this whatsoever, but I've just noticed out of our portfolio companies, most of them prefer to raise from family offices now because it's really flexible capital. Diligence is much more expedited, and you don't even need to worry about going through the hassle of going through an IC. And I think we're going to see that more and more, especially as some of these companies don't need to raise as much cash to do what they can do now.
Look, I know that New York will create the venture firm that only does common stock. And the reason being is in every single part of the finance world, the goal is to make things highly liquid. Venture is the only part of the market where they create such complexity that it takes 6 months or more to do diligence. Or they just go in blindly and hope it's regular diligence. But you have to do this liquidation stack and all. But that kills the valuation because with secondary getting stronger and stronger, you really would rather see funds start getting created that say, look, we're going to play a sector of every startup in this category. It's such little cost to do that. If I did a Vanguard-like fund and I had let's say a $500 million fund that just created liquidity around seed and A.
Yeah.
That arbitrage alone, because the valuations fluctuate very quickly. So that would create such great algorithmic training opportunities for people looking for alpha. And yet no one thinks about that way because they're like, oh, no, we have to do an investigation of this stuff. And I had a great board member who was at News Corp. And and this is like going back in time, but he was the guy who was in charge of Columbia Pictures when they did Slumdog Millionaire. I think it was Columbia Pictures, but it was Slumdog Millionaire. And I would go out with him at night and I'd be like, dude, how the hell? Like a film based in India with a heavy Indian accent in America. Like, you thought that would be a home run? How the hell did you figure that out? And he was like, Steve, it's very easy. And I was like, tell me. And finally I got him drunk one night. And he was like, I was like, you got to tell me how you knew. And he said 12. And I was like, what is 12? He's like, all you need to know is 12. And I was like, what the hell does 12 have to do with anything? Is that like a lucky number or anything? He's like, no, you always do a film slate of 12 films a year and one will hit. And I was like, there's got to be more to it. He's like, no. He's like, that is the secret of Hollywood. They're always crap. One turns out to be great, and you just don't know which one is that rare moment. He's like, we've tried doing everything from picking and doing all these matching and trying to put together people. He's like, no, it's just 12. He's like, I know it sounds crazy. He's like, I just learned the lesson, and you don't sweat over it. And that is very much tech. You sometimes don't know.
Is that why your fund does one a month or so? Is that the 12 a year?
We don't do any external investing. I mean, that's the reason why it's a builder's market. And you need to be treating venture funds more and more like an index fund, I think is.
But I do like the idea of like this startup ETF, right? Just kind of, arbitrage together a bunch of seed and Series A type companies. Have you heard of something like this on the market before?
Actually, I was a general partner at PJC for a couple of years, and we looked into doing it, and it was it's difficult. You'd have to be a bigger fund than we were to pull it off, and then you have to figure out how do you make sure you don't have a negative signaling issue, right? How do you make sure you actually get a good swath of investments and you don't just get like all the people that couldn't raise money from Sequoia? So
I think, look, I think if you were what you learn from first round is if you're the fastest money in, the first one to put it down, the best go to you first, because you're just looking for, as capital raise, you're looking for speed. I mean, that is sort of if you're looking in the Sequoias and the others, they're just trying to get to know everyone so they can be the first money in and move fast. They're not getting any signaling other than, I like this group. First round was in the middle of godforsaken nowhere, but the fact that they would move that quickly and lead, which is like the fear of everyone, which is, oh my God, if I pick this wrong. And I thought they did a great job on that. So I expect the East Coast will be better at that. And even in the end of the day, if you have sort of a negative signaling, it tends to be such a small amount versus the dollar amounts, especially when you're talking about seed A and B. It's really now you're more talking about like, okay, if I get OpenAI wrong, and I'm in the, because that seems to be the greater fool theory right now, which is like, can I get in before the next fool who buys it at a higher price? If you can get in there, that's sort of a different game. But I don't think people need to play that game anymore. You can essentially go buy on the market, that kind of stuff. I think it's more the lower stuff that you're trying to get into. And by the way, I also think hedge funds would love to be able to long short that versus the public stocks.
Yeah.
So I think that's the thing that will be the biggest innovation around software companies, is you'll see liquidity around stock in a much different way.
So going back to, it's hard to raise money here in New York. It was in the early days.
I still think it is.
And now you're in this scenario where, this is the number 2 AI market. When you tried to get me to move here, but I moved to Boston in 2010 because Boston was a clear number 2 after Silicon Valley in 2010, and sort of 2014, 2015, New York passed it in terms of tech and startups, and now is one of the biggest, after Silicon Valley, the biggest AI hub in North America. And I would argue a better AI hub because it's very applied and the stuff people are doing, we're not obsessed about AGI and all that stuff here. And so what do you think happened? What do you think drove that change?
Well, one, it's nice to hear you say I was right, even though you denied it for a long time. So thank you, Rob, for that. I appreciate that. I don't need that for my ego, but thank you. Look, I will say there are benefits in New York, again, which is the large amount of capital, family offices, hedge funds, et cetera. I still don't think we have the heritage. We're way too conservative. I think if you look at New York continues to grow really quickly. We will have, when we finally have a major breakout moment, a Facebook, a Google, et cetera, and the people who make that much money are now ready to invest quickly because they know about it. I think that's when New York will break away from everyone else and its natural strengths. Remember, before World War II, New York was Silicon Valley. So, this is, the California anomaly is thanks to silicon chips, but it's an anomaly. And the reality is it's a great place to live. It's wonderful. But they are an echo chamber that is both good and bad. For them. I think New York is open to lots of other ideas that would not be acceptable in the Valley. I don't think Collectivei would work in the Valley. as an example. I think our current business works really well because we have thinkers here. And sometimes people think thinkers are good. I think they're both good and bad. So I have a theory about sort of what makes California work so well that some people don't like. I'm happy to share it, but I'll tell you what I think New York has advantages over that, but it's up to you guys. It'll piss people off, so it's up to you.
Yeah, you can share it. That's fine.
Are you sure?
Go right ahead.
You sure?
I think
We're all
that's
for it.
half of this podcast's purpose.
All right. Well, look, I have a lot of crazy opinions, and you can disagree.
Well, I've had you on.
But look, I think the interesting thing about California is that they are extremely great engineers who really don't want to think. They are the smartest dumb people you'll ever meet. They don't broaden their horizon beyond anything else, and they're always looking to follow what everyone else thinks is smart. So why do I think that's an advantage? Look, in New York, when you have an idea that's new, people really want to debate the idea. They want to, and debate is the form of way you understand the idea, and it helps you to think it through in a way that you can add to it and create some value. And in Silicon Valley, nobody wants to add it to anything. That's why there's a cult of Larry or a cult of Mark. The mere fact of I can say Larry and Mark and everyone knows the name should tell you how small of a pond that place is. Because if I say Mike here, which Mike could it be? If I say Larry, it could be, I mean, there's 500 of them.
Yeah, media mogul, real estate developer.
Oh my God, Larry Silverstein. I mean, I can go through like 1,000 of them, but there you don't. So what happens is people are in such a rush to be successful that they will blindly follow you. And do you know the speed of an organization when they're like, Mark says, and then they don't think. They just go and do the best that they can do with their engineering degree, and they will create the best, you pick it, design, webpage, whatever it is. They'll never think, they'll never question. And that's why Silicon Valley moves in these like memes where you're like, okay, like even the meme of that we're going to talk about today, which is like, is AI like a bubble? Okay, like are LLMs a bubble? Well, they can't even deal with the like, okay, are we having like any gray in this? It just has to be, this is good, this is what I do, and I'm going to be the best at it. And they'll move so quickly because they don't need to know anything other than my part of this is to do this small thing, and I'm going to do it really, really well. And I think that's an amazing thing that they have. It's also their weakness. It's their Achilles heel. And where I think in New York, the benefit is, yeah, it takes longer to get everyone around the table to agree with it, but then everyone brings something to it. And so we tend to create much more interesting companies we will end up having our big breakout. Everyone likes to forget that Meta or Facebook didn't start in the Valley, started on the East Coast, and then it went there to get all the talent and to get followers who just follow. But I think we'll end up keeping one of them and really rock it.
Yeah. We've had some successes here, like MongoDB, I think is a big example,
they're great.
Datadog.
These are doubles and triples. We haven't had our home run. And I think that's what I think the entire weight of the country shifts. Because again, no one's from California out there. Like Silicon Valley is an anomaly. It is a small capital base, but they know what they're doing. They'll put money out fast. I think New York has way more money, not enough going into venture, but it doesn't matter. You see the sheer gravity of New York, that we've become the second biggest, and we have great companies. But it will naturally take its place again at the helm because all those people will fly and move here, and we'll have the combination of both of those.
What is a home run? Is that a financial return? Is that a cultural kind of like phenomenon that happens? Like, what is a home run?
Look, that is a company that throws off so much cash and draws so much talent that it is the gravity, it is the sun that pulls everything into its orbit, right? Like I said, people didn't grow up in California and go to work at Google. They flew from everywhere in the world to be paid more money than God, to have the ability to have an impact on something and to be a part of something bigger. New York, by its nature, is a sun. Right? We bring in the best from around the world who are the smartest, who come here for a lot of different reasons beyond tech. And so if you had that kind of a gravity on top of New York, the talent would flee. As beautiful as Palo Alto is, one, you can't survive as a single person in Palo Alto. Two, it is the ugliest people outside of Boston that you'll find with no style. And the food sucks. So you end up in a place where, And by the way, if you work in Europe or Asia, it is the worst of all time zones because no time zone fits. Whereas in New York, you have a 12-hour time zone for Asia, 6 for Europe. Is a great place to work, and you have the best of everything. So I think what will happen is we'll have our, call it Meta or whatever it is, and they decide to stay here because they love the New York area. And then everyone who's left will move over here. And I think that's the natural order of things.
Yeah. It also begs the question, like, what is the pull to moving to New York? And I do kind of see this natural story arc where, especially during this period of time where we've been heavily innovating on foundation models, of course they're going to flock to the Bay Area. Of course they're going to look for the best possible engineering and technical talent that they can. We are entering a phase of that journey where, and this gets into the theme of kind of our core discussion topic today too, where we're graduating to the application stage. So we're getting to the point where maybe we're starting to enter the trough of disillusionment a little bit, and we're starting to think through what is the unsexy stuff that we have to do to actually get this done. Which brings us to the first article we wanted to talk through today. Ryan, do you want to introduce that one for us?
I mean, I had to say before we hop into topics, just because I'm so excited about this, is last show I said we were hiring 2 engineers, right? We hired our first one, and I'd say almost half our applicants now are from Silicon Valley applying. And the number one reason they say, as much as I know they're excited about our company and they say that in an interview, is they're like, we want to be in New York. Is that something that
how
many times are you hiring now and you hear people from Silicon Valley saying, hey, I hear what's going on in New York. This is very exciting to me.
Look, no matter how well you've done in California, in Silicon Valley, you're in a small pond. Like, that's the hard thing. Like you asked me for a New York story. I'm going to do it early. Is it okay?
Yeah.
Okay,
Go ahead.
I'll give you a New York story. So we sell LinkShare, and it's a $500 million exit. It's all cash. It's not a bad exit. And a buddy of mine runs a fund of funds, which for your audience is funds that invest in other funds. And he invites me to a dinner on the Upper East Side, and I never go to the Upper East Side because, it's on the Upper East Side. And he invites me to this beautiful mansion, and it's a dinner with the top 10 hedge fund people of that year. And they're going through their ideas, and it's crazy because they're talking about the monolines are about to crash. And I end up sitting next to Bill Ackman, who, funny enough, went to my high school, who plays tennis much better than I do. And we're sitting down, and he turns to me and says, I don't know you. I know everyone else here, but I don't know you. Who are you? And I say, I'm Stephen Messer. And he goes, well, what is it you do? I go, I'm in tech. And he goes, what's your company? I say, LinkShare. And he goes, I know LinkShare. Now, this is one of those moments in New York where you're like, holy crap. Like, this is awesome. Like, inside the belt, okay, I understand. Inside the industry, I get it. But here's this like successful hedge fund guy.
On that one?
Yeah, I'm feeling really good at myself. And I'm like, yeah. And he's like, yeah, you work with this one company that we are backers on, and they rave about you every board meeting. You guys are producing a lot of cash for us. Thank you. And I was like, well, that's great. He's like, can I ask how big is the business? I was like, well, we just sold it. He's like, that's fantastic. What was the final sale? And I said, it was $500 million. He's like, my God, that's amazing. He's like, imagine what you could do if you put your mind to it. Now, you have to understand, his salary for that year, personally, was $1 billion that year.
Wow.
He earned individually $1 billion. And that's the thing about New York, which is, okay, in the Valley, I'll have a Larry, I'll have a Sergey, I'll have a Mark, but everyone else is in like this like caste system of like, where are you at in this world? And okay, if you're a huge VC, you're below the founder, but you're in a good place. If you're a top engineer, and they're in a caste. In New York, I can sit at a dinner, and we took the subway back. He didn't have a car and bodyguards. Like, we took the subway home. That's New York. Nobody matters here. And yet everybody does something. And I think if you want to be the best, you don't want to be in a caste system.
Yeah, no, it's a good segue because the dichotomy for our first topic here, from the Atlantic, how big is the AI bubble? We kind of talked about it earlier, but I feel like we're in that duality where it's more real than ever. The impact we see from entrepreneurs making in the economy today is really incredible with all different LLM-based systems. But at the same time, we're seeing a lot of things get funded that you're like, I think either they don't have revenue or they're inflating their revenue, and we're unsure which it is. So what do you see on the ground right now in terms of bubble or real traction?
So let's define bubble in the private markets, because that's very different than public valuations. To me, I'll define a bubble as when the technicals of the business have been overtaken by the financial gaming of the economics. Because private markets are much easier to game. And so if we talk about AI as being in a bubble, that's not going to be, that's not true at all. If we're talking about LLMs, which again, there seems to be no more gray in this world. Everything's got to be like 100% one or the other. Somehow AI is like all LLM. And that is far from the case. I think if you had asked me, and when Rob and I met 10 years ago, we were talking about how I don't want to do anything around language, image, audio, and video, because it was by its nature always going to be a commodity. And we were like, that reminds me of Lycos, Alta Vista. And, their job was to organize the web. The web was public. That's not a great business. Google won, not because they had a better search engine. Google won because they stole the economic structure from a third party who they had to pay a lot of money for after, before their IPO. But taught them how to make more money so they could always beat out. So the winner of LLMs will be if someone can figure out an economic model. No one's figured that out yet. But if I look and say, if we're looking at AI generally and you get out of the LLM space, and I'll talk to you about why I think LLMs are in a bubble in a second. But if you get out of it, I look at China, dark factories, that is AI. Right? They are now able to manufacture at a low cost, lower than their neighbors, because there's no labor anymore. What's the robotic situation in our manufacturing world? Zero. So you've got have a very fast path up, especially if, God forbid, there's a war, in particular in Taiwan. You will see manufacturing with dark factories spring up. But I think there is a complete missing of investment there because every factory needs to get there fast because we can onshore a lot more. Onshoring is important for us. We've learned, given the tariff situation, self-imposed wound, but wars generally have hurt us. We saw what happened during COVID. There's a real reason for that. So is that done? No. If I look at war and robotics and war and AI, the very beginning, 40% of our budget, barely any of it's going to AI. Anduril has done a great marketing job, but look at their stuff, nothing there. So are we talking about this? I can talk about Collectivei. We focus on essentially the study of how the world does business, barely scratching the surface of that. So there are huge amounts of upside on AI. Then when we get to LLMs, there's difference. Here's where you see financial engineering at its best. And this is why I do think we're probably in the LLM world is in for some pain. One is everyone's economically motivated because it's driving chip sales. It's driving, which is important for the public markets because that's the only place they're getting growth. So you've got to be able to show you can get growth there. I don't know if that's a bad thing. Everyone keeps talking about a collapse. I think if there's war with Taiwan, people would be glad that we have a lot of chips on storage. Two, I think you're seeing a lot of the private players who've raised a lot of money who now have to publicly talk about it being a bubble because they don't want another competitor. DeepSeek was scary enough. All the models coming out of China are scary enough. And so they're trying to talk down competitors, happens to be just when they're going public. And they've also, the day after they raise a lot of money, thank God there's no one cynical here who would think that the
I saw it was a public company. Zuckerberg just the other day casually said, even if we have to burn a couple $100 billion, it is worth it in this moment. That's right, teetering on hyperbole, or is that a real financial return that as investors are excited about?
So I was just at the AI infrastructure conference in San Jose, and the VP of infrastructure for Meta spoke. Meta's a little bit of an anomaly in the AI world because they're so vertically integrated. They're building chips that just drive recommendation engines, right? Which nobody else would, you couldn't sell those chips to the general public. There's not a big enough market. But they can design silicon at that level. They obviously have been building their own data centers for a long time. And then all the way up, they control the monetization. They control all the way up, right? They control the network, they control the monetization, they control every layer of the stack.
The revenue streams are very diversified.
Yeah, and so they have a really interesting opportunity to benefit from AI in ways that a lot of other people don't.
Yeah, it's a great point, Rob.
And I think it's part of what's hard about this article and hearing are we in a bubble or not is I kind of agree with Steven on sectors of the AI market definitely are. OpenAI is probably a bubble. I think I don't see how they're going to lean into that valuation. I've actually thought about since they've got the supposed $300 billion deal with Oracle, it's like, should you short Oracle under the idea that like OpenAI won't be able to raise the $300 billion to pay Oracle and, stuff like that. Like, I think that's a little bubbly. But there's definitely pockets that are doing fine. I mean, and when you get away from LLMs, like people still use a lot of SVMs and CNNs and stuff like that. And that's going really well. Like machine vision in your normal applications is great. Humanoid robots is probably another place where there's a bubble. These 5, 10, $15 billion valuations. I don't know if they're going to live into that anytime soon, but that's
that's why you heard me talk about dark factories, not humanoid robots cleaning your house. I mean, look, I think you're right. I mean, look, the thing about it is it's easy for Zuck and OpenAI, and I'm going to say Dario soon, to start talking about a bubble because they need to stop other people from raising money because it is a commodity. It is a horrible place to be. But also you have to remember, all of Wall Street, you're now getting past the point where it's an innovation, now it's a trade. And once you're in trade land, what everyone's trying to figure out is how to move the market both up and down. They need to create volatility. So they're benefiting from this because you're going to have people wanting to talk it down before the IPO because they have to go IPO. And everyone gets excited by these things. So what you're seeing is the traders are really playing this game. Like when they did their raise, was that OpenAI going to like a whole bunch of people and saying, "Hey, Larry, will you invest $2 million?" No, they had Goldman, everyone else selling it to their private wealth people. This is the greater fool game. And this is the parts of where the financiers are trying to figure out, how do I pass off to the next person the tag so that I don't get stuck with it? Because it's a trade. It's not an investment. It's now a trade. And so I don't know if bubble means the same thing. And I think when people think about bubble, they're like, oh, this thing won't really work. And it was a fool's errand. And they're trying to point to some problems of LMs, or they're not growing as quickly as they should have been. No, I don't think that's true. I think we can see people use it. They're incorporating it into everything. It's becoming a big, major part of society. Whether it be commodity is a different story. The second thing is we're now in trade land. There is no thesis other than hyperbole around, will this be a good trade? And I think that's the bigger problem that we have.
But I'd love to hear, and we'll put you on the spot first, and we'll let you have the last word of number one bubble within the sector of AI specifically, and number one real traction across all the different verticals or horizontal opportunities. What's the number one thing that you're bullish about, and number one thing that you're like, all right, this definitely seems a little bubbly?
Oh, I think coding agents are a complete bubble right now. And I think part of that, and I'll talk about this in a bit when we get to our next article too, but part of that is this idea of, do you as a company own the distribution, or do you own the underlying rails that are creating value? If you own the distribution and the access, probably that technology is going to get commoditized, and that's exactly what we're seeing in this market. I think it's going to be a race to the bottom. On the other side of that, I think we are entering, and I wouldn't call it a bubble, actually. I would just call it a market correction. Like, you look at customers' expectations, not even diplomatic. Like, I'm so bullish about AI and the capability of it to change things, but I think we are kind of reaching a point where our expectations are getting corrected. And you saw that in the Meter article to the Atlantic article that touched on the study results from this think tank Meter. I think we're reaching a period of time where the focus will become, how is this actually adoptable within the industry? And there are a lot of unsexy processes that come along with like operationalizing that technology. And so I think that's where I'm really bullish. Like, I think the people who really stick it out through this kind of trough of disillusionment to actually figure out, how do we adopt, how do we actually like operationalize this within a really big company where your data is a mess? I think that's going to be the really interesting part. And the company is in that next wave that can own the actual implementation phase will do quite well.
What about you, Rob? What you got? Bullish on something, bubbly on the other.
I would agree with the coding agents with Anna. I think that's a bubble. I think you're going to see there's still a lot of upside in AI in areas that we haven't talked about much yet. So like, I think you're going to see edge AI coming, and I think that's going to happen. I think you're starting to see the typical AI technologies around LLMs move to other parts of the stack in terms of what they're doing with the with the ability to write code. And I was on a call last night. I'm part of a Google group that talks a lot about AI and where it's going, and it's private. It's run by a guy named Adam Saw here in New York. and everybody was talking about how they use these things, and people are starting to set up all these infrastructures that give these LLMs, like, put them in a box and give them lots of rules and guardrails and
Tools.
very complex prompts and all that kind of stuff. And that's the kind of infrastructure that you have to build to get more out of these things. And this idea that, like, they were all going to be super gigantic AGIs that you could single shot prompt and just, get everything that you wanted, I think is bubbly. And I think people are starting to move, because it's not just the valuation. People are moving off the, like, AGI, ASI bubble as well, which even 6 months ago, it was like, we're less than a year
All steam
away.
ahead.
Yeah, and now it's like, well, this might be another decade or more before we build these super smart machines. It seems like they're still missing a lot. So I think it's been bubbly. I think you'll see a little bit of a correction, and but I'm still, I think, like everybody else, very bullish long term.
I would say again, I push on this bubble thing because really where the bubble is where you have traders playing the game, not is their intrinsic value. Look, you're not wrong on the Harveys and look, you can look at Windsurf. They didn't want to take the company for the full price. They're like, you keep it. I don't want it. And went over to Devon, and, good luck with that. But like that's, if you're an investor, you should be thinking to yourself, well, isn't that a warning sign? But I think what it is just there's happy years, which is you've had 6-7 years where no exits. And if you see something go from 0 to 100, do you care if it's got barriers to entry? Or
No.
do you think to yourself, all I need is OpenAI or Anthropic or Facebook to buy this because I'll get an exit? And I get that. That's why I said when you're in a trader mentality, you stop thinking about fundamentals. Like every time I ask someone on the West Coast or East Coast even, where are the barriers to entry? They're like, look, barriers to entry we can figure out. That's a weird place to start saying, I'm going to put a multi-billion-dollar valuation on something, and we're going to figure out the only thing that matters.
Yeah.
And I watched. You saw Cursor try to raise its rates, and everyone just say, "I'll leave." Let me ask you, of the people here,
I moved off Cursor when they did that.
Okay, everyone moved off Cursor. How about this? How many of you have gone to the place where now you have Gemini, Anthropic, and OpenAI for free, and when you run out of credits, you just switch each day?
Yeah.
Yeah. I'm there.
Token margins are very, very challenging right now.
I'm not paying the $20 anymore. I get enough from like bouncing between them, and I don't really care.
Yeah.
Like, there's nothing. In fact,
They're all very similar.
They're all very similar. Anthropic's got an ugly interface, but like generally, they're all pretty much identical. I can't tell the difference, and I don't really care to tell the difference. And I think this is sort of where you're seeing the trading mentality. I think I don't know if there's going to be a trough of disillusionment because you've got 3 players, and I actually think of the meta players in particular. They may look, if there is an encirclement of Taiwan by China, and Xi keeps saying he wants to do it desperately, and now he wants to live forever, so eventually he will.
Yeah, 2027. Right? That's the deadline.
That's what he keeps saying. How smart will all the players like Meta who have a revenue stream look for stockpiling chips that they will probably resell 3 years later, a month away from burnout, but people will pay full price just to get any access to chips? So I don't know if it's actually a bad thing or it turns out to be fortuitous, which is why, bubble talk is about for trading, not for the business that we live in.
There is the underlying question of like, where will that value accrue, even if the value does sustain? And this is, so I was really excited to talk about this article this week. It's an article in Colossus magazine by Jerry Neumann called AI Will Not Make You Rich, which, to get a bit more macro, compares AI to previous technological developments and makes a statement that actually value is not going to accrue to most of the operators or investors in this space. And if you weren't one of the early foundation model companies, you're probably better off kind of riding this wave, but it's not going to make you billions of dollars. And the idea is that, value is going to accrue to the end customers. It's not going to accrue to predominantly any new operators in this space. So I guess my question for all of you, maybe we can start with Ryan because you're to my right. Do you think that AI is a disruptive technology or an accelerating one?
It's almost, it's more important about how you think about the actual end user implementation. It has nothing to do about the technology. At the end of the day, it's just, is it easy to have someone say, instead of having this water today, I'm going to pick up a different type of water and it not be a big change for me day to day? I think everyone, in going back to your point, Silicon Valley is full steam ahead. AGI is here. We're going to be the first one to get there. That feels very disrupting to anyone outside of the Valley. But when we talk to customers, and this is just a personal, kind of understanding, is we try to dim down how much we say this is AI and LLM driven. We just say, hey, this is a more modern developer tool for you.
Yeah.
This is something that your team won't feel a huge change in their day-to-day, but they'll just go much faster and be happier. So I think it's an accelerator for the companies that are trying to be customer focused and just really, really get to the end user's day-to-day lifestyle, not, hey, we have the coolest tech ever and everything's gonna be better for you. All you have to do is completely change your entire way of life in your company. So I think it's a big accelerant when you do it thoughtfully for implementation.
Steven, do you have thoughts on this?
I mean, I'm not going to talk about LLMs because I think LLMs are commodities by their nature. So trying to debate what's going to happen to a commodity is a commodity. I mean, cars and airplanes became generally bad investments to make because they're high CapEx and low long-term value. We at Collectivei, we focused on an economic foundation model because we saw high barriers to entry, but also huge economic impact. So an economic foundation model just studies how the world does business. So imagine if you're a big company, you may not know this, every Friday they have to ask their salespeople, what will they close? And then they get back a very interesting answer of a manipulated, how do I tell you a great story and nothing's real? And so that has real impact on people. They either wait till the end of the quarter and then fire a ton of people or find out they didn't put enough money in. So these are things that have real pain points. If you can predict what's going to happen to their business with a high degree of certainty, well, now you start to change the way they operate. You can start shipping products like Amazon does, right? Amazon ships the product to you before you buy it. That's how certain they are. So this can change an entire economic order. Well, that's a business where everyone has to contribute their data to get the value back. So I think what you're going to start to see is, I remember in 96, 97, 98, the only thing people want to talk about was search engines. And honestly, it's great that Google's done well and they've sold up, but does anyone really care about search engines? I mean, we were desperately looking for an alternative, which is why we liked ChatGPT when it came out. There just hadn't been a better alternative because nobody liked search engines. They really sucked. So I think this is where when sort of the LLM realizations come in, you're going to see all the other businesses that are actually changing everything that are heavily AI, and that's when you'll really see what's changing the market.
I would say with respect to that article, I definitely liked the containerization, the shipping container, analogy. I thought that was really good. I think I think in general, there's always pockets to make money in any industry. Even if the general industry sucks, there's some piece you can peel off. It might be TAM limited, but there's something you can do to peel off the most profitable customer segment and resegment that market or whatever. But I think in particular with AI, a lot of what's gonna happen is it's gonna make it easier for everybody to do everything, which is gonna lead to more competitive markets for a lot of markets, particularly a lot of markets that are digital. Now, I think when you have networks or when you have some kind of proprietary distribution, channel partnerships, relationships, like these kinds of things that are hard to get or that AI can't get on its own, that require human relationships, that I think there's still a lot of opportunity there. I think if you play in places where humans are still going to want to show status over other humans, I think that I always give people the example of when cell phones came out, watches went away for a while because we used to wear watches to tell time, and now it was on your cell phone, but they sort of came back as status symbols. And I think that'll happen with some things because of AI. So I think it'll be in general harder to find pockets to make money, particularly in tech, than it has been. Like SaaS investing was just so easy and crisp, and
20 years of almost guaranteed return.
Yeah, and the metrics, just everybody knew the metrics, and it was, and so yeah, we're not in that world anymore.
But SaaS also was a shit investment. I mean, you have never had a company that gets more than 20% market share. They almost have no market clout to be able to get a premium. I mean, you can look at Salesforce as the best example of a bad business model, right? I mean, if Larry and Sergey ended up with 20% market share, they would go to the top of the Chrysler building and they would jump off.
Yeah.
They would kill themselves. And so it was again a really good model for a C- finance student who could do a basic spreadsheet and figure out CAC and say, okay, and they're going to need a certain amount of money. But there's been no exits. I mean, your best option in SaaS was to sell to Thoma Bravo or Vista.
Yeah, and there weren't a lot
really
of
a deep payer.
And there weren't a lot of barriers to entry in a lot of SaaS businesses. So
yeah, look, I mean, Constellation Ventures was the greatest example of that, of buying really small ones,
Yeah.
but no VC wanted to go into those deals.
yeah,
And those were the best deals to be in because there was no competitor really in those marketplaces.
yeah. They were
So,
really smart about
but
that.
by the way, your point is 100% right about networks. You saw Sam is not a dumb guy. He was talking about for a long time trying to make ChatGPT some kind of social network on top of it. Because
Yeah.
if you're thinking about competing against Meta, who has WhatsApp, who has Messenger, who has Facebook, who has Instagram, you're probably thinking to themselves, if anyone's going to be able to create an economic model where there's lock-in to their LLM, it's them, and you're trying to figure out how do I get out of it. Even their crappy share version, you could see was sort of a nod to Google and their productivity suites.
Well, we're getting close to wrapping up, and we end every episode with a best or worst of New York, and today most interesting. So our idea for today was, what's the most interesting New York conversation you've overheard? You gave yours earlier in the day, but one of you guys want to go or talk about it?
Yeah, what have you been eavesdropping on, Anna?
Yeah. First of all, everything. Second of all, this is a one-sided conversation. I saw a guy talking over the phone, and so I have no context for this whatsoever, but he says, and I quote, "I'll do what I have to do, but I draw the line at Machiavellian. I'm not willing to destroy someone." And I almost like that out of, like, with no context whatsoever. First of all, the man who said that, come find me because I want to know what the context was behind that. Second of all, which episode of Succession were you filming? Like, it just felt so classic New York Midtown. That's probably my favorite. Ryan, what about you?
Yeah, it was the other Friday. I saw, a couple of the girls out and about, ready to have a night out on the town, and they were on the phone with, it seems like one of their boyfriends or something like that. And she's like, "You called a regular Uber, not an Uber Black? Do you know who we are?" And I was just like,
That's amazing.
I was like, "Come on, guys, like, get in the Uber, it'll be fine."
So about a year ago, I was walking down 7th Ave in Chelsea, and I'm walking behind this mom, and she's holding hands with this little kid. And as I get closer, I hear them talking, and the girl's like, "No, I want to stay up," and they're late tonight, and they're arguing or whatever. And she's like, "Can we watch a movie? Can we watch a movie?" And the mom's like, "Sure." And then the girl goes, "Can we watch one of the movies Daddy made?" And I was like, "Oh." So like, I'm like, who is this? Is this like a director's wife or an actor's wife? I mean, I probably wouldn't know anybody like that. Yeah, I don't, possibly like, I don't know very many celebrities. Although I did like literally almost run into Alec Baldwin one time in West Village when he was pushing a stroller. But it was so like I walked at that pace for 2 more blocks with them so I could hear the conversation, which was fascinating because clearly this little girl who was probably 7, 8, 9 years old knew that her father made movies. And I was trying to like get more information to see if I could tell who it was, but it was a really cool conversation over here.
Did you figure out who it was?
I didn't know. So,
But he is now on a watch list for
Yeah.
stalking.
yeah. Finally, the mom was like, "Hey, what are you doing?" No, I didn't walk that close. Cool. Well, Stephen, thanks for being on today. This was a lot of fun. And for all of you that are watching, thank you for watching. Do all the things that you're supposed to do, please. So like us, subscribe, send us requests for things we should talk about, guests we should have on the show. And we hope to see you next episode.
Thanks for having me.
Thank you.